So we are fast approaching 2026 and Perth has officially reclaimed the growth lead. Prices are at record highs and momentum is only continuing to tick up. Today, I'm going to show you exactly where Perth sits right now, what's driving it, as well as my scenarios for the next 12 months. Plus, if you stay till the very end, I'm going to touch on where I'd be focusing if I was investing into Perth today. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians grow their wealth in the Australian property market using data. Data that's accessible to absolutely everyone. So with that being said, let's jump straight into the video. So where does Perth sit right now? Well, if we look at the median dwelling value, we're at about 800K, which is night and day compared to where we were just a few years ago. In terms of the monthly rate of growth, if we look at the most recent data out from Cotality, Perth's growing at about 0.9% on a month-to-month basis. Quarterly, it's at about 2.6%. And if you look at it annually, and again, this is historical, it's not forward-looking, we're at about 6.5%. But if we were to just annualize that quarterly rate of growth of 2.6 on a forward basis, we're growing at more than 10%. And I've been looking at some of the more recent data, such as the daily indices, and they indicate that the growth is even quicker than that. So the question is, what's driving it? Is it sustainable? And to answer that question, we need to look at the dynamics on the ground, the demand and supply, and the balance between those two. Let's start with supply. So to look at supply, let's bring up this chart from REWA. And what this shows us is what the total listings in Perth are this week, what they were 4 weeks ago, and what they were same time last year. So you can see that this week, we're looking at under 3,000 listings for the whole of Perth. And you're probably sitting there thinking to yourself, well, that doesn't mean anything to me. Well, a balanced market, and let me just define what that means. A balanced market is when demand and supply are pretty much in alignment. It means that prices effectively are going sideways. The market's not too hot, it's not too cold. It's like your Goldilocks in the middle. They say that a balanced market in Perth is about 14 to 15,000 properties. And when you see the number 2,981 properties, that's not just undersupplied. That's chronically undersupplied. This is a market where properties will effectively go like hotcakes. Now, you look at it compared to same week last year, we were at 3.6K. Still chronically undersupplied, but the fact that we've gone even lower is simply unbelievable. There was actually a period just after October last year where listings actually started to pick up. We got up all the way to 5,000, and a lot of pundits out there thought that, well, it wasn't the end of Perth, but certainly that supply was improving. Well, it's proven not to be the case. We are now at the lowest level of supply that Perth has had ever in recorded history. Ridiculous. Now, that's the supply side of the equation. Now, let's look at the demand side of the equation. And to do that, let's look at the sales market. So this is another chart from REWA. And if we have a look at it, we can see that the median days on market, that's the number of days it takes for an average property to transact. So if it hits the market today, then how many days does it take to sell? That figure is now at 11 days, which is ridiculous. I mean, 11 days for a property to sell. It has been a little bit lower. If we look at this data, it did get under 10 at one point, but 11 is still a very, very hot market. I mean, they say that if it's under 20 or 25, that's like a pretty heated market. So 11 is just ridiculous. Like there would probably not even be things that are on your supermarket shelves that move at 11 days, let alone a property that requires people to go through it and everything like that. Vendor discounting. So this is how much of a discount a vendor or a seller needs to provide to a prospective buyer. That's just at 2.9%. That's how much, if the price of a property was advertised, it ends up selling for 2.9% less. So sellers don't need to cut their prices by much to get rid of a property. Again, an indication of a very strong demand in the market. So the other thing I wanted to touch on was sales volumes, which is effectively the number of properties that are being transacted every single week in Perth. So if you have a look at this chart again from Reva, it shows you the number of properties being transacted. This most recent week, it was 824. If we compare that to 4 weeks ago, it was at 830. Same week last year, 793. Again, doesn't tell you much. Let's look at that figure in the context of supply. Now we know that there's less than 3,000 properties on the market. So if we're selling 800 a week and there's 3,000 on the market, what that tells me is we have 4 weeks worth of supply, which is ridiculous. It just effectively means that if no properties get listed again, then we will be out of supply in Perth in 4 weeks. Insanity. You put both of those things together and you have a very red hot market. Now let's touch on rents, yields, and the investor story. So rents are continuing to rise. The most recent data from Cotality shows that rents are up about 5.1% year on year. Definitely slower. You know, that figure was closer to 8, 9, even higher in previous years, but we want to be relative here. That's still higher than the pace of growth in Melbourne and Sydney. Median rent sits at about $690 per week, and I would expect with population growth, and I'll get to the investors, but there's less investors now in the market than there were 12 months ago, I would expect for there to be more upwards pressure on rents. The yield has definitely compressed. Yields are sitting at about 4.2% gross. That figure was at 5, 5.5, even 6% a few years ago. So definitely seeing some yield compression, but that's not through rents reducing. It's purely through the median price of dwellings going higher and higher. Although we're seeing some yield compression slightly over the quarter as prices outpace rents, it's still quite attractive nationally. That's still a stronger yield than what you're going to be seeing in Melbourne, certainly Sydney. As I said, some investors do chase yields, and there are stronger yields in other parts of the country, namely Darwin. In terms of investor share, WA, we're sitting at about 36% of new loans are going towards investors. Again, doesn't tell you much, but what we typically look at is if we're in a market and it's over 45, 50% share of investors, that's when we know things are getting pretty bubbly. So we're nowhere near that, and that's actually pulled back. We were closer to 40, even just a smidge above 40% last year. But as I said, that investor story is beginning to shift a little bit. Demand from investors still remains strong, but again, we are seeing more owner occupiers in the market. Now, let's move more and discuss about the macro side of things. So what's happened this year? Interest rates, that's the biggest story of all. We saw another RBA cut in August, taking the cash rate to 3.6%. But we know, looking at the futures markets, there is more cuts likely left in the tank. The futures market, again, it kind of bounces around a little bit. It's forecasting between 1 or 2 more cuts into next year. 1 this year, 1 next year. Again, lots of volatility there. Who knows what that will be? No one knows, but that's what the market is saying at the moment. So mortgage rates, they are edging a little bit lower. I've seen fixed rates recently as low as 4.99%, where you can lock in for 2 years with Macquarie. So that's the interest rate side of things. Again, feeds into the demand side of the equation. Obviously, the lower interest rates are, the more attractive the property market looks, not just for investors, but also owner occupiers who are looking to upgrade, who are looking to buy a new property, first home buyers. Again, all of this is likely to spur demand in the Perth market. So with that said, what are my forecasts for the next 12 months, again, heading into 2026? I'll start with my base case. I'm going to say, and this is, again, base case. When I say base, most likely scenario, I'm going to say between 6 to 8% growth. I think we're going to see quite strong growth, certainly in the second half or the last quarter of this year, even heading into the first 2 quarters of next year. And then I think the pace of growth will moderate in the second half of the year. What are the assumptions behind that? Listings remain below average, or well below average, as we've discussed. Population growth and rental pressure persist, and another RBA cut filters through, which is what what's expected. And as a result, that scenario assumes that investor demand holds. Population growth is currently running at about 2.39%, the fastest of all the states. So again, if those factors eventuate, I'm going to say 6 to 8% is quite likely. What about the upside? So upside, I'm going to say 8 to 10%, might even be a little bit more. What would require that to happen? Listings would need to stay very few and far between well into spring. So I wouldn't want to see listings go above 5 or 6,000 listings because supply is the enemy of capital growth. Rental growth would need to stay firm. So would need to be growing rents at about 5, 6%. And why? Because we want to make sure that investors stay in the market, because it's not just owner occupiers that drive growth, investors do as well. If rents don't continue to grow, yields will continue to compress, and therefore investors won't find Perth to be an attractive market. So if rents continue to rise, investors will stay in, and that upside scenario is more likely to eventuate. And then I would expect that growth will tend more towards the mid and up tier of the market, and I'll touch on that in a moment. Under that scenario, we would grow at about 8 to 10%. And there's the downside scenario, which I think is incredibly not likely. I would be very surprised if this scenario were to unfold, but we would need to see in spring listings rebound materially. And when I say materially, I mean well north of 6,000, 7,000, 8,000, trend more towards that balanced market figure, which we know is 14 to 15K. On top of that, we would need to see unemployment rise, particularly in sectors that impact Perth, so mining and more generally across the board. If we see that, as well as construction completions, which at the moment don't even talk to me about construction completions because nothing is getting off the ground. But if that started to rise, well, again, that would get more supply into the system. It would be more likely that we would see that downside scenario play out. But again, from everything that I'm seeing right now, I consider that to be a very unlikely scenario as we currently stand. So what are the things to watch closely? Again, spring listings, any catch up in that would reduce pressure in the market. Secondly, the construction pipeline. Again, it's still constrained in the near term, but any jump in completions could cool rents. Building times, we know, have doubled in the last decade. It's now taking, I can't even believe this, 18 to 24 months for a property to get from approval to completion, or at least from commencement to completion. 2 years. That time used to be under 12 months. And in, the eastern part of the States, it still is 12 months. So there's just a chronic shortage of trades in Perth. And on top of that, those workers are working on government projects, on the metro net, on all sorts of other things. They're not building houses. And if houses aren't getting built, we're not getting any supply into the market. And then the other thing I'd be watching is jobs and rates. Another interest rate cut from the RBA is going to spur demand. If that happens, obviously that's another demand side factor. And then the labor market. Just keep an eye on the unemployment rate. If that begins to creep up, which we're not seeing just yet, but if that does, again, you got to look at all of these things in unison. So with that said, it's a lot of information. The answer is, where would I be focusing now? I think what's important to mention here is that the lower end of the market has already surged. There's suburbs and areas like Armadale, like Gosnells, like Mandurah. These areas have already grown by more than 100%. They've more than doubled in value, and some are actually getting close to tripling in value. Would I be investing there? No. And when I say there, I mean really it's that lower price segments of the market where people just a few years ago were buying houses for 200, for 300K. Those properties are now worth 600, 650K. I do not expect there to be material growth left in those markets. Where I would be focusing on, I'd be shifting to the middle and higher end of the price bands. These haven't moved as aggressively. They've moved, absolutely. Everything in Perth has moved, but not as aggressively. There's markets where there's only been 70, 80, 90% of growth, and there is likely still some growth left in the tank. Where's that sweet spot? It's the mid-tier family suburbs, near schools, near jobs, near transport nodes, right? There's going to be upgrade demand in those markets. There's going to be individuals that have, let's say, bought in Armadale, bought in worse areas, and now they're ready to upgrade. And they're going to be upgrading into those mid-tier suburbs that have what I call amenity, or the prestige adjacent areas that have lagged but are now seeing more depth. So, the more expensive and more affluent areas of Perth. The other thing I'd be focusing, potentially a value add play. So if you're going to buy in some of those mid-tier areas like Naranda, areas like Morley, Or even if you're looking at south of the river, look at value add plays. Try to look at properties that have value add potential. Can you do a renovation there, an extension, a subdivision? Is there future development potential? Again, look at these things. Make sure you consider zoning. I'll have other videos out on those topics in the near future. So the other thing I would consider is also the investor lens. Yields are much tighter at the top. So if you're looking at the more prestigious suburbs that Perth has to offer, your yields are going to be compressed even further. So we were talking just then about a 4.2% yields. On those more expensive, more affluent areas of Perth, it's going to be materially lower than that. Whereas if you stick with the mid-tier suburbs, your yields will still stack up in those areas. So those are the areas where I'd certainly be focusing on if I was entering into Perth. So with that being said, Perth is still the nation's momentum market. We've got low stock, strong rental demand, and cheaper credit ahead. I'm expecting solid mid to high single digit growth over the next year, with upside led by the mid to upper tier markets. Guys, if you found this video valuable, I'd appreciate if you leave a like down below. And if you're interested, I've got absolutely free, link down below, I've got my free asset due diligence checklist. I look at this every single time I'm reviewing a property. It's got about 40 critical factors that I consider before any purchase. If you want it, it's absolutely free. Just have a look in the link in the description. I'm going to have more content coming out just like this. Subscribe. Guys, I'll see you in the next one.